In March 2020, the U.S. stock market lost $11 trillion in value in 22 trading days. $11 trillion. People watched their retirement accounts collapse in real time. Panic flooded the news. The question everyone was asking was, where did all that money go? Did it evaporate into thin air? Did it burn? Did it simply cease to exist? No. And understanding where it actually went is the difference between being destroyed by a market crash and being enriched by it. Today, we are going to follow the money all the way through. First, understand what the stock market actually is. It is not a vault where money is stored. It is not a savings account. It is an auction, a continuous 24/7 auction where millions of buyers and sellers agree on prices in real time. When you buy Apple stock at $185 per share, someone sold it to you at $185. When you sell it at $120, someone bought it from you at $120. The stock market does not hold money. It reflects the price people agree to pay. That is a critical distinction. When the market drops 30%, the number on the screen changes, but that number was never stored money. It was a valuation, an agreed price. And agreed prices can change the moment fear enters the room. You own 100 shares of a company at $50 each. Your portfolio shows $5,000. The market crashes. Those shares drop to $30. Your portfolio now shows $3,000. On paper, you lost $2,000. But here's what most people miss. You still own 100 shares. You did not lose a single share. The price changed. The ownership did not. If you hold, the loss exists only on a screen. It is a paper loss, temporary, unrealized, reversible. The moment you sell those shares at $30, the paper loss becomes a real loss. You locked it in. You converted a temporary decline into a permanent financial decision. This is the single most destructive mistake ordinary investors make during a crash. They see the number fall. They feel the pain. They sell to stop feeling it. And in doing so, they give away the recovery to whoever bought what they sold. A market crash is not a destruction of wealth. It is a chaotic, violent transfer of wealth from one type of investor to another, from the emotional to the rational, from the panicked to the patient. When fear drives prices down 40%, what is actually happening is this. Person A bought Apple at $180. The crash drives it to $110. Person A panics. Person A sells at $110, locking in a $70 loss. Person B has been waiting. Person B has cash on the side. Person B has done the homework. Person B knows Apple's fundamentals haven't changed. Person B buys at $110. 2 years later, Apple is at $200. Person A, who sold at $110, watches from the sidelines. Person B has an 82% gain. The stock did not change. The company did not change. The only thing that changed was who owned it. Crashes don't destroy wealth. They redistribute it, always from the scared to the strategic. So if the money doesn't disappear, where does it physically go? When investors get scared, they move money out of risk assets. This rotation follows a predictable pattern. Stage 1, out of stocks. Investors sell equities. Stock prices fall. That cash has to go somewhere. Stage 2, into cash and bonds. U.S. Treasury bonds rise in price as scared money floods into safe havens. Money market funds swell. Cash positions build at brokerages. Short-term government bonds see huge inflows. Stage 3, some moves to gold. Gold historically rises during equity crashes. In 2020, gold hit all-time highs while stocks collapsed. It is a fear asset. It stores value when paper assets feel unsafe. Stage 4, sitting on the sidelines. Billions of dollars move to cash, waiting, ready to re-enter. This dry powder is what fuels the recovery rally once confidence returns. The money doesn't disappear. It parks itself in safety and waits for the opportunity that a crashed market creates. Normal fear causes markets to drop. Forced selling causes them to crash. Here is what happens beneath the surface. Many large investors, hedge funds, institutional traders, leveraged ETFs, borrow money to invest. This is called margin. When prices fall 10%, their broker issues a margin call. Your collateral is now insufficient. Deposit more cash or we sell your positions. They cannot deposit more cash. Their positions are forced sold. This selling drives prices down further, which triggers more margin calls, which triggers more forced selling. This is the domino effect that turns a 10% correction into a 40% crash. The ordinary investor did nothing wrong. Their fundamentally strong stock was sold by someone who had no choice. The price collapsed, not because the company failed, but because a leveraged fund got a margin call at 2 a.m. on a Tuesday. This creates the greatest pricing inefficiencies and therefore the greatest buying opportunities in financial markets. September 2008, Lehman Brothers collapses. The S&P 500 loses 57% of its value from peak to trough. What happened to the lost money? Millions of ordinary Americans, terrified by news of banks collapsing, pulled money from their 401ks, sold stocks, moved to cash, locked in real, permanent losses. Meanwhile, a different group was watching. Warren Buffett, large institutional funds, patient individual investors with cash reserves. In October 2008, Warren Buffett published an op-ed in the New York Times. The title, Buy American, I Am. He was buying when everyone else was selling. The S&P 500 bottomed in March 2009. By 2013, it had fully recovered. By 2020, it had tripled from its 2009 low. The panic sellers of 2008 and 2009 handed their assets to patient buyers at 40, 50, 60 cents on the dollar. Those patient buyers held through the recovery and were rewarded with generational wealth. The crisis did not destroy wealth, it transferred it precisely, ruthlessly, permanently. Understanding where the money goes is only half the equation. The other half is knowing what to do with that knowledge. When the market drops, ask yourself 4 questions. Question 1, do I need this money in the next 3 years? If yes, it should not have been in stocks. Move to safety. Preserve capital. If no, the crash is noise. Do nothing. Question 2, do I have an emergency fund separate from investments? If no, build that first. A crash is not the time to be forced to sell investments to cover emergencies. If yes, your foundation is stable. Proceed. Question 3, do I have cash available to invest? If yes, a crash is a sale. Quality companies at 30 to 40% discount. This is exactly when patient investors buy. If no, hold what you have. Patience is still your best tool. Question 4, have the company's fundamentals changed or only the price? If only the price changed, then nothing has changed that matters. The market will reprice correctly over time. The framework in one sentence. If you don't need the money soon, have an emergency fund, and the company is still strong, a crash is not a threat. It is an invitation. The next time the market crashes, and it will crash, you will hear the same words. Catastrophe, collapse, billions lost. Now you know the truth. Billions were not lost. Billions were transferred from people who did not understand what they owned to people who did. The question is never, should I be afraid of the crash? The question is, am I positioned to receive what others are panicking away? That positioning starts now, before the crash, while prices are calm, while you can think clearly. Build your emergency fund. Invest in quality, diversified assets. Carry no unnecessary debt. Hold cash reserves for opportunity. Do that, and the next market crash will not be the worst financial event of your life. It will be one of the best. If this changed how you see the market, share it with one person who panics during downturns. It may save them from their most expensive mistake. Subscribe for more content that builds the financial clarity most people never develop.